this week's market update, China surges on trade deal hopes, where next for America's jobs market, and Westminster gears up for a make or break Brexit week. Well, China is the big market story this week as shares in Shanghai and Shenzhen soar to a 9-month high, with year-to-date gains hitting nearly 30% in just 2 months. Investors have flocked back to Chinese shares after last year's slump reversed direction in spectacular fashion. Yesterday, the market was up 3% higher at one stage as the focus shifted to the annual People's Congress in Beijing, amid hopes for more monetary and fiscal stimulus and a resolution of the long-running trade spat with the US. The Wall Street Journal raised hopes over the weekend that a meeting between President Xi and President Trump at the end of this month will be used to sign a trade agreement between the world's two biggest economies. The threat of a full-blown trade war between the two has hung over global stock markets for months now, with fears rising that at least half and perhaps all of China's $500 billion or so of exports to the US could soon be subject to a 25% tariff. Currently, $200 billion of exports have been hit by a 10% levy. More recently, shares have rallied on signs that negotiators are finding common ground after a period of intense shuttle diplomacy between the two countries. Any trade deal is likely to include reduced tariffs on the Chinese side, as well as a promise by Beijing to buy more from America and to ease technology transfer demands. As well as that, shares have also benefited from hopes that the Chinese authorities will respond to slowing growth expectations, with further investment spending to boost activity. The need for further stimulus is shown by the slowdown in growth in China to around 6%, as expansion slows to its worst annual rate in almost 3 decades. Yesterday, Chinese Premier Li Keqiang announced a target growth rate of between 6 and 6.5%, and he confirmed a series of tax cuts to boost growth. Beijing seems to have realised that the early stages of a trade war is not the moment to be persisting with a deleveraging programme designed to rein in high corporate debts. The mood music out of the National People's Congress is unusually frank this year. Mr. Li said China faces profound changes in our external environment. He added that China-US economic and trade frictions had an adverse effect on the production and business operations of companies and on market expectations. That's pretty strong stuff by the normally cryptic standards of official Chinese comments. Chinese shares have also received a boost in recent days by MSCI's decision to quadruple the exposure of its emerging market indices, which are tracked by funds worth nearly $2 trillion, to Chinese mainland shares. Raising the Chinese weighting obliges many passive tracker funds to buy Chinese stocks to maintain their exposure to Shanghai and Shenzhen. It's thought that the latest move, part of an ongoing rebalancing of global indices to better reflect China's influence in markets, could see up to $125 billion flowing into the country's equity markets this year. China is aggressively opening up its capital markets in the face of the ongoing trade tensions with America. Although Chinese listed stocks in Hong Kong and the US already feature in MSCI's indices, Beijing is keen to create a stronger link between the domestic Chinese stock market and the vast flows of international capital. By November, therefore, more than 250 large capitalisation Chinese stocks and about 170 in the middle rank will feature in MSCI's emerging market index. There will also be 27 companies listed on the Chinext market. That's China's equivalent of Nasdaq, and it's the home to some of the most dynamic and innovative Chinese companies. The impetus for a trade deal reflects the need for both President Xi and Trump to deliver growth. For Donald Trump, facing headwinds on many fronts at the moment, and with an election only 18 months away, the challenge is particularly significant. Failing to strike a nuclear deal with North Korea last week and facing mounting calls for his impeachment as the Mueller probe into potential collusion with Russia draws to a close, he needs a quick win. This Friday's non-farm payroll employment data will give us the latest insight into the health of the US economy. Around 180,000 new jobs and a jobless rate of under 4% are the current consensus. That would follow 304,000 new jobs in January and an unemployment rate of exactly 4%. Attention will focus in particular on the wage growth number, with January's 0.1% the weakest rate of growth since 2017. Although trade tensions are widely seen to punish China the hardest, American companies are also in the firing line. Following 2018's big tax cuts, the growth outlook has become materially more difficult this year, evidenced by slower growth and gloomier trading statements during the fourth quarter earnings season that's now drawing to a close. This week, there's a handful of companies left to report, including retailers Target and Kohl's, as well as bookseller Barnes & Noble and warehouse outlet Costco. On this side of the Atlantic, results season is very much still in full swing. High-profile names reporting on their 2018 full-year figures include Direct Line Insurance, Legal & General, Paddy Power, Betfair, Just Eat, Admiral Group, Aviva and Greggs. On the Brexit front, this week is expected to be the lull before the storm, although Prime Minister Theresa May has deliberately left all options open by promising a vote on her withdrawal deal no later than the 12th of March. In theory, therefore, she could call for this crunch vote this week if she feels she has negotiated enough of an improvement in terms to persuade her rebellious Eurosceptic backbenchers to fall into line behind her plan. As it stands, though, next week would actually be crunch time, with 3 votes on 3 consecutive days in the parliamentary diary. These are a vote on the withdrawal deal on Tuesday, which, if it's voted down, could be followed on Wednesday by a vote to allow or to rule out a no-deal exit on March the 29th. And assuming that no deal is taken off the table, as most people expect, then Thursday we'll see a further vote on extending the Article 50 timetable. So the question now is whether the Eurosceptics are prepared to sacrifice what they would see as an imperfect Brexit in their bid to achieve a perfect one. Mrs May is counting on enough of them being more scared of no Brexit than of a compromised one. She's made it clear she wants only a short extension to the end of June to avoid Britain having to take part in European elections in May. The EU, on the other hand, is thought to favour a longer extension that would allow a people's vote, possibly, a general election and, in extremis, a complete rethink of Brexit altogether. In the middle of all the Brexit drama, the Chancellor Philip Hammond is scheduled to unveil his spring statement. That sits alongside the autumn budget as one of the Finance Minister's 2 set-piece speeches of the year. And the timing of this year's statement is significant because Mr Hammond said in his October budget that he had about £15 billion of room for manoeuvre thanks to better than expected public finances, and that he was holding that back as an insurance policy against a potential hard Brexit. If Mrs May's withdrawal deal is voted through, therefore, he's likely to start spending that cushion. In fact, the government is already beginning to loosen the purse strings with a proposed £1.6 billion of further spending in marginal Brexit constituencies, albeit spread over 7 years. Unsurprisingly, the Labour opposition has criticised this as a bribe to persuade undecided MPs to back her deal, while others have said the money barely scratches the surface of the problems already caused by a combination of austerity and Brexit. Now, the market impact of the latest ups and downs of the Brexit saga have been a sell-off in safe haven gilts and a rise in the pound, both of these on the reduced prospect of a disorderly no-deal exit at the end of the month. The sell-off in UK government bonds saw the yield on 10-year gilts, which of course move in the opposite direction to their price, rise by 16 basis points, 0.16% last week. The pound, by contrast, climbed by more than 1% against a basket of its major trading partner currencies. Domestic stocks too, which tend to perform well when a softer Brexit seems more likely, have also been outperforming larger, more international focused FTSE 100 shares.